like, isn't arms the whole reason that everything blew up and like made the entire world end? Like, I kind of have this notion that arms are bad. Arms. Bro, you got some nice What are arms? What are they for? What does it stand for? And how might they be a solution in this state of our interest rates?
Absolutely.
So gentlemen, this is Aaron and Jason with First Coast Mortgage. I'm Josh Rogers with EXP. And we just want to be part of the conversation. It's kind of like us hanging out so you can like be a fly on the wall and hear what this sounds like. Let me just set the kind of the tone. From the housing bubble and the recession, like, isn't arms the whole reason that everything blew up and like made the entire world end? Like, I kind of have this notion that arms are bad.
I'm glad you brought that up, and they're definitely not bad.
What's it stand for first?
Adjustable rate mortgage. So
Okay.
what that means is a 30-year fixed mortgage never changes. Your rate, your payment, principal, and interest never changes. Mm-hmm. An ARM is an adjustable rate based on a certain period of time. It could be a 3-year, 5-year, 7-year, 10-year. That's the fixed rate period with that.
So the ARM rates are typically lower than the straight 30-year fixed rate.
I see.
So
that's the benefit.
Yes.
Okay.
So the difference now versus the rates back in the bubble where everyone is potentially still scared of an ARM is that there's a certain period of time that's fixed. 5-year, 7-year, 10-year. So for the person that knows, maybe they're military, maybe they know that they're going to be moving, right? So they know they're going to be moving probably in 3 years. A 5-year ARM is a better option, maybe. So it's it's not a taboo word. It's not like it used to be. The client may be able to get, the borrower may be able to get a lower payment for that period of time without the risk because they know they're not going to be in that loan forever.
So it's a legitimate tool in the toolbox as
Yes.
long as it's used properly.
Correct.
Back then it was exploited and completely mismanaged.
Correct.
Okay.
Yeah.
Correct. And they also had shorter term ARMs, like 6 months, like a year, like 2 years. So, that's a little short in the time frame. So definitely a good tool to use for sure.
So the last question that I have is, let's just say you have a 5-year ARM, 3 years from now, the rates drop. What could you do at that point?
Man, you can refinance out of that ARM into a 30-year fix. You're not locked in to the ARM. So if they drop, go right into the 30-year fix, assuming that it meets your criteria on where your goals are with the house.
Interesting.
I think also that before people were not putting money into the house. So now, typically 5, 10, 15, 20% usually. Let's say you have some appreciation, let's say that goes down, and let's say rates do drop a few years from now, then you can refinance. So, you're not completely locked into that loan for the term, but you just have to be careful that, this isn't your 30-year home and you're doing a 5-year ARM.
Well, and another point to that too, Josh, is that just because it adjusts doesn't mean it skyrockets. A lot of times the margin in the index isn't really that much of an increase. There's been occasions where it's gone down. So it doesn't mean because you have an ARM that it's going to double in rate.
Okay. So if I'm a buyer who's kind of paralyzed and afraid right now because these rates are really high, an ARM may be a good solution to look at.
Yes, absolutely.
Cool. Thanks, guys.
Thank you.